Thank you very much for doing this. I have been looking forward to having this discussion with you for a long time. As you know, we are interviewing a number of people around the world on the subject of the future of the global financial system. And I can't think of anyone who is more in the middle of the crucial issues than you. So I'm looking forward to asking you just a variety of questions. But I think maybe to begin with, it would be great if you could talk just a little bit about the central mission of the BIS.
I think the central mission of the BIS, since it was created, that it was in 1930, so it's a long time ago, has been cooperation among central banks in two areas, monetary stability and financial stability. And at the same time, we provide financial services. So we are a bank of central banks. It's a special bank because our shareholders are the central banks and our depositors are the central banks. But the important part is the cooperation in financial stability and monetary stability. And it has been for a long time.
And it is a very unique kind of organization. So let me ask you this question. Does the organization itself speak for all of its members, or does it also have an independent voice?
I think the merit of what we call the Basel process is the discussion that the central banks have among themselves. But in addition, and as a contribution to this discussion, the BIS has its own research, and we try to provide central banks with a global perspective and with a medium-term perspective. And I think then with their discussion and our contribution, they have to take their own decisions according to their mandates, etc. So yes, we have our own research, our own voice, and we try to introduce these elements in the different discussions and in the different committees that work here at the BIS.
Okay. If you were to look back, let's say, at the last decade or two, and just point to what I would call some historical inflection points in which the role of the BIS was particularly important, what would be just a couple of events that gives us a sense of exactly how you operate?
I think this is a good question. I think the BIS has been an institution that has been able to re-engineer its role with time. And in the past few years, I think before the financial crisis, when probably not many were paying attention to financial stability. Today, everybody is paying attention to financial stability. Everybody has something working on that area. But at that point of time, I think the BIS was working really very hard on financial stability. I think this was one of the important elements of why the BIS has been so relevant. And issues such as macroprudential or procyclicality, things that are now widely used and widely accepted, were started to be thought about and to be researched at the BIS early this century. In 2000, there was a famous speech of one of my predecessors talking about the need not to concentrate supervision on just individual institutions, but to have a systemic view. And I think this has been extremely useful when the crisis came, because this is part of the solution, to have this systemic view. So I could mention this. I could mention before that the role of the BIS was significant in the building up of the monetary union. The governors were meeting here. So there have been quite a number of important roles. But for this discussion, I think this financial stability issue probably is the most important and most relevant.
Okay, so let's talk now about the 2008 crisis. Arguably, the most serious, truly global crisis, in our time. Describe the BIS's involvement. First of all, let's first confine it to the crisis period, the crisis management period.
If you don't mind, I would like to start a little bit earlier
Okay.
and link it to the previous question.
Okay.
Before the crisis, there were a couple of important messages that the BIS was sending. One, monetary stability, price stability is not enough to guarantee financial stability, and therefore is not enough to guarantee economic stability. I think the consensus, or at least a lot of people were thinking that if you get monetary stability, if there is price stability, and you get efficient markets, everything will work fine. You don't need to pay much attention to financial stability. I think the BIS was right in saying that that's not the case. And in some occasions, it's even necessary to think that when there is too much moderation, more risks are taken, and you should be even more cautious. So that was a message that was even before the crisis. Now, the second message was the one that I already mentioned about macroprudential, the need to have a systemic view. And again, at that point of time, it was not very often that the notion of procyclicality or interlinkages among different parts, and most importantly, interlinkages between the financial system and the real economy was highlighted so much. Now everybody talks about that, but it was not the case. And I think that on that, the BIS was very right. And certainly I'm not talking about me, I'm talking about my predecessors that were there, that were right. And some of the colleagues that still are here, Borio or people that has left, Bill White, that were developing these theories. So when the crisis came, I think it was very important, all these pieces of research that had been done in the previous time. Now, I think the crisis period, which is in the acute phase of the crisis period, I think it was extremely important, the decisive action that central banks took at that point of time. And on some occasion, it was coordinated. And I think the fact that the central bank had been meeting here very often facilitates some of this coordination. For example, the creation, the setting up of these swap arrangements, etc. I think it was clear that the cooperation that has been helped in that sense. But again, I would emphasize that at that point of time, the critical point was that central banks, in somehow a coordinated manner, at least in some areas, took decisive actions and did whatever it takes, is where this sentence makes all the sense. It makes all the sense that central banks do take all the measures and use all their tools, conventional and non-conventional, to stop the process of deterioration in financial markets, clogging financial markets, and impairing the role that financial markets have to have. When this is melting down, central banks have to step and act. And I think that was critical, and that was the right thing to do. So that was the first part.
So I think this is a very strong theme, that you are providing a place, a forum, where views can be exchanged and where relationships can be developed, and that puts you in a very strong position for whatever kinds of events arise. So, continuing with that, let's talk about the post-crisis period, say 2008 until 9, and I'm going to ask you to talk about this in two ways. One, the function that the BIS played, and secondly, the BIS's view as an institution itself on how the post-crisis period has been managed.
Okay. So first, what has been our role? I think our role continues to be the same. We try to make sure that there is a strong cooperation and that the right themes are properly discussed, and we prepare these discussions thoroughly. And this has been very important in the post-crisis period. And we have discussed many important themes of common interest for the different central banks. At the end, it's important to emphasize that although these are discussions that we are having through different committees, at the end is each central bank within their own mandate that have to take their own decisions. We provide with, I hope, valuable additional information of what is going on in other parts of the world. That would be one part on the economic side. But there was also another response, which was the necessary change in the regulatory framework. And that was done through the different committees that are hosted here at the BIS. The Basel Committee, also the Secretariat of the FSB is here at the BIS. And I think they have provided with a very rapid response in terms of building up a much more complete framework of regulation. And I could develop a little bit on those two themes. But your question was, what is our view? And I think if you follow our different annual reports, and we have just come up with the latest annual reports very recently, you could see that we, again, from this perspective, long-term perspective and basically global perspective, there are a few themes. And I would like to summarize this with the three transitions that we have asked for in this annual report. The first transition is, we think that it would be important that the patterns of growth are less debt-driven that we have had in the past. And again, we could elaborate on that, but we could not base the growth of the global economy on just financial booms. We need to think more in terms of productivity. We need to think in terms of better use of the resources, etc. So that would be one thing.
So
the second is
just on that. Would I be right in categorizing that as a view that we need more structural change and less borrowing to stimulate?
Yes.
Okay.
Yes. I think we need to do more on that, on the camp of repair and reform, as we try to summarize.
Okay.
And perhaps less in terms of the traditional demand-driven policies, because in this kind of crisis, they tend to be less effective, and with time, the balance of risk and rewards tends to worsen, tends to get more difficult as time passes. So that was the first thing. The second thing is the transition to a more normal monetary policy. As I said, it was absolutely necessary and it was critical, the good reaction of central banks. But as time passes, the balance of risk is changing, and we need to normalize at some point of time monetary policy. And this will not be easy. So that is the second transition.
Now,
and the third
when you say normalize, you mean getting back to central banks allowing markets to set interest rates and not keeping monetary policy so easy. Am I right?
That's correct.
Okay.
That's correct. I think it's not easy to say what should be the rates. That's something that, but certainly these are rates that are too low, and these will have to normalize, whatever is the new normal. And the third transition is the transition towards a more resilient and more reliable financial system. And I think this involves all these aspects that I have mentioned about regulation, but it involves a lot of actions that should be taken by the private sector, and it involves also supervision. It involves a number of different elements that we can discuss. So these are two. So these were to summarize in three transitions, these are the three transitions that we think are necessary. And as you say, do every central bank agrees with all the elements? Probably not. But again, we are not trying to provide something that in contrast what they are doing. What we are trying to provide is to add some medium-term or long-term and global perspective.
So I'd like to just stick on these three transitions for a minute, because I think it's a very vivid description, and I read your recent speech on this, which I thought was extremely interesting and also quite provocative. Let me ask you about each one with regard to what it is that you're saying and what you think the distance is between what you're prescribing or what you're recommending and what the actual course of action seems to be. In other words, to what degree are you pointing to something that is quite far away from what is happening, or to what degree are you basically codifying what is already in train, but you just like to see it go a little faster. So let's take each of those transitions, and in terms of how far a distance is there to go from where we are.
Okay, so let's start with the less debt-driven
Okay.
growth pattern. What we have seen is that debt has continued to increase, even though we are talking about that the leveraging phase. The truth is that since the beginning of the crisis, debt has continued to increase. And I'm talking about both public debt and private debt in different ways and in different countries. And it is true that in some countries there has been some deleveraging. United States, there has been some private sector deleveraging. In some of the countries that were more in the midst of the crisis, Spain, UK, other countries, these countries have delivered in the private sector, but they have increased in the public sector. But overall, when you take the G20, the debt today is higher than the debt at the beginning of the crisis. So if we were concerned there, we should not be very relaxed today. And the numbers are significant. So it's, I mean, you can count it, but it's 40 trillion more debt now than there was at the beginning of the crisis, which is 20 points of GDP. So it has to continue to increase. These figures do not give the whole picture. So it's just an indication, because the truth is that at the same time, banks have deleveraged, they have increased their capital, and therefore they have gained some solidity in their balance sheets. Still, the asset side in some areas needs to be worked out, but there have been progress in some areas. Perhaps it's better distributed because now it's more in the capital markets, not so much in the banking sector. So there are elements that probably mitigate these figures that I have mentioned. But the truth is that the debt has continued to increase. And most importantly, perhaps we have not paid attention to these other factors that come with this kind of crisis, which is that with these booms, normally, in addition to the debt overhang, in addition to the impairment in the balance sheet of the financial institutions, which are very important, there are other elements. And the other elements is the misallocation of resources that occurs during the slow process of building up these imbalances. So you can see that there was too much construction in some countries, too much finance, and this needs to be changed. This is not something that can be just done through lower interest rates. You need reallocation of resources. This is structural reforms. This is getting repair balance sheets. That's not just. So when we say that these crises are different and that balance sheet crises are different, that's what we mean by that. We need additional measures, and we have not paid attention to that. And even, I would not say most important, but there is another thing, that when we were in the booms, we were not paying attention to other problems, to other probably, I would say, structural deficiencies that were happening. But as growth was okay because of the booms, we were not paying attention. For example, in advanced economies, we have seen a declining in productivity. Perhaps we have not paid attention to that. And this was before the crisis, and to some extent has nothing to do with the crisis. The crisis may have aggravated points here and there, but this was even before the crisis. So again, the message is, yes, there is a demand gap. Demand policies can help, can provide time, but they cannot replace the other policies. And if the other policies have not been working before, some of the effects of the monetary policy will not work. It will be much, much less effective. If the balance sheets are not repaired, monetary policy will be less effective. If the misallocation of resources is not repaired, is not solved, is not addressed, there will be less effectiveness in monetary policy. If the economy is not flexible, the monetary policy will be less effective. So that's what we try to say by that first concept. It's a pretty important, from our perspective, concept, because things go together. The financial booms and this misallocation of resources go together and need to be solved together.
Okay.
So that was the first.
That was the first. Give me no, that was great. That's exactly what I think. It really clarifies where the power of what you're saying, or the magnitude of the challenge here. So go to the second.
Second is we need to a transition to normal monetary policy. And we know that monetary policy, aggressive monetary policy and unconventional monetary policy was necessary. I explained that before. But again, as time passes, the balance of risks and returns changes. And basically what happens is, as I explained, that just monetary policy alone it will not be able to solve all the issues because some of them are of a structural nature. But at the same time, low interest rates is saying low price of leverage. And if there is a low price of leverage, and part of the problem is leverage in the economy, I mean, we have to be careful not to keep low rates for long, because what we will get is additional leverage, and what we will get is additional risk-taking in the economy. Financial markets can get too dependent of monetary policy and maybe less concentrated on the analysis of the potential scenarios. They may be concentrated too much on narrow scenarios, thinking that low rates are going to be there for a long time, and perhaps they, in that sense, they are pricing for some kind of perfection that may lead to too much risk-taking. And the risk-taking is not happening in the real economy, which was the intended effort. We are not seeing that companies are investing in new plants. Of course there are, but at least part of it is going to financial markets, not necessarily to the real economy. And I think that indicates that, again, it's not just monetary policy. Now, the additional element is that we think that there has been so much that has been done in terms of monetary policy that we should think that the transition to more normal monetary policy is going to be bumpy. Financial markets are going to have doubts and are going to create volatility. And what it has been called the taper tantrum that we had when it was the beginning of thinking about purchasing less in the case of United States, purchasing less securities, indicates that this is the case. And therefore, I think central banks have to be ready to understand and to think that this volatility will be not a necessary process and should not delay the normalization. I think a great deal of the discussion has been emphasizing that it would be bad if this stimulus, monetary stimulus, is removed prematurely. We try to bring to the table the other view too. So there is also risks if you delay too much and you postpone this normalization of policy. And we express in the view that now that the global economy has been healing, there is still very disappointing, but a modest prospect of better growth. I think these are tailwinds that should be used to start this process. And each central bank will have to do it when time comes. It is their decision. It will not be at the same time. It shouldn't be at the same time. Each one has their own constraints, their own situation. So we are not saying when each of them should be doing. This is not our role. But we are emphasizing that it is not a one-sided risk. There are two risks. It is the risk of doing too soon, but there is also, and this risk is increasing, of delaying too much the normalization of monetary policy.
So on this point, it sounds to me like you are providing a very coherent sort of alternative set of scenarios to policy as you know, just the momentum continuing along the lines of what it has been. What is the implicit time frame that you have in mind when you talk about a return to normal policy? I realize every bank is different, but in aggregate, are we talking 1 year or 5 years? I'm just trying to get a sense of how much urgency is behind what you're saying.
I mean, it's not an easy question, and we have not gone as far as to, again, say that. I think that There has been the starting talking about this tapering thing has started in the United States. UK obviously is also more advanced. Europe is a little bit more delayed. Our message is basically when time comes, do not delay. And if there is volatility in the market, do not postpone things just because of this volatility, because this will be inevitable.
Okay.
No matter how good communication is, there will be, or at least we should expect, it should not be abnormal to have this kind of volatility. Perhaps communication can help, but we don't think so. We think that the communication has been pretty good, and I think it's natural that there have been so many measures taken that there will be volatility, and our message is don't postpone. Things to some extent have started by this talking about this tapering thing that is already happening. What we are thinking is that this should stay course.
Okay. The third transition.
Yeah. The third transition is to a more resilient and a more reliable financial system. And these are two different words. First, on the resilience, I think there has been progress. And I think this is part of the reform. In terms of the regulatory part, there has been enormous progress. If I start with regulation, there has been enormous progress in the design of the rules. Most of the rules are already designed, and we are in implementation phase.
So which rules? Give me 3 examples of the rules you're talking about.
Well, we are talking about Basel III, which sets capital and liquidity. We are talking about all the rules and around the process of resolution banks. We are talking about OTC derivatives, trying to make the infrastructure safer. And we are talking about too big to fail. The other elements, the first is resolution, but there are other elements that are also included. And the rules about shadow banking.
Okay.
These are the big building blocks of the regulatory agenda. Most of it is designed. Still, there are a few parts that need to be completed. So I think the priorities now is to complete these parts, and most importantly, to continue the implementation and making sure that the implementation is consistent across countries. And there are a few issues that we can talk. The other element...
Let me just stop there. Those issues, those are obviously big issues, and the question I want to pose to you is, there is an awful lot of commentary that the international coordination of the rules is is way behind what is desirable, and that in fact what may emerge is different national standards that will be much more difficult to reconcile in the real market. I think I hear you saying that you are much more optimistic about, let's call it a set of global rules. They won't be perfect, but the ability to mesh these rules, among jurisdictions. I just wonder if you would comment on that, because you're obviously you're in the key position to see the differences and to evaluate just how significant or not significant they are.
I think this is a very good question. I think usually in crisis, what the tendency, the normal thing would be that each country tries to find their own solution to their problems. There are urgent issues, and you think that, okay, I need to solve it, and I go my way. I think this is a risk, and I think to a large extent we have succeeded in not falling in this trap. So I think still we have as the basis the international agreements that are taken at international level. And this is done by the real protagonists. So when they meet in Basel, it is the supervisors that take their decisions at home, that meet here and share their experience and decide to have these standards. Now, these standards are minimum standards. So each country can decide, I want to have a higher standard, and this is the case. It has always been the case. And for example, I am in Switzerland. Switzerland decided to have a higher standard in terms of capital and is requiring higher levels of capital than the minimum standards. Now, I would not underestimate how much has been done in terms of the minimum standard, because usually people say, okay, well, it was 8, now it's a little bit more. Okay, I think I would say 2 things. If you put all the capital elements together, it could get to about 15 in a boom cycle capital. But most importantly, the quality of the capital is almost 3 times, equivalent 3 times to the previous quality of the capital, because the truth was that when the crisis started, there was no capital. Right. Capital was extremely thin. There was something that was called capital, but it had no absorption capacity without creating resolution in the institution. So now this has changed dramatically. So the capital has been multiplied by a significant factor. I agree that it's good to have good cushions of capital, and I agree with those that say we would like to have even a higher level of capital. But at least we are all talking the same language. At least we are talking all the same basic regulation, and everything is based on this agreement that they have agreed. It's their agreement. It's the agreement of the regulators and central banks that meet here in Basel. So I think we have succeeded, but we will need to continue, because there is always the tendency to go your own way and to do it differently because it fits better to my country. But that would lead to fragmentation, and nobody wants to go back. This will be moving backwards. So we continue to struggle, and the different committees that are meeting in Basel continue to struggle to improve the systems and get a better consensus, and most importantly, a better application, better enforcement of that. And on that, I could talk. There are still issues. There are still the issue of how different institutions are calculating, for example, the capital on the basis of the risk-weighted assets. This is technical, but it is quite significant, and a lot of work is being done to solve some of these I would say discrepancies across jurisdictions and across institutions. But I would say, yeah.
How about when it comes to something like resolution authority? My impression is that this is one of those areas where if there were to be a major failure of a global bank tomorrow, we have a long way to go before there's a common resolution mechanism or anything like that. Am I exaggerating that?
No, I think you are right. We don't have a common resolution mechanism, but in the same way that you think a lot needs to be done, and I agree, I think if you look backwards, a lot has been done.
Okay.
And there, part of the work has been what it is called the key attributes, and the key attributes basically tell, okay, you may have different systems, but there are key elements that should be present in all the systems. And these key elements should be in whatever is your resolution framework, should meet these key elements. And this has been implemented, is being implemented in different countries, and it is very important because it allows to make sure that when the crisis comes or when a failure comes, there will be the resolution authority. The authority will have the powers that are needed, and perhaps even most important, it will have the powers to coordinate with other authorities cross-border. And these are quite a significant changes from the previous situation. We are getting closer to be able to resolve institutions during the weekend, which is what you need to do in a real financial crisis. And then there are still elements that are being worked out, because we are in this resolution key principles and resolution regimes. There is the concept of the bailing element, so that you can not just wait for a bailout, but bailing some creditors. That to some is a very important concept, and it is also a concept that to some extent reduces these too big to fail disincentives or wrong incentives. So more work is needed. Now there is some work on what it is called GILAC for SIFIs, for systemic financial institutions. which is additional loss absorption capacity in the case of resolution in a gone concern, so that operationally the company can continue to do the basic things, basic functions, and therefore is easier to solve. So there are plenty of elements. There are resolution plans that the companies have to make, a very important discussion with the supervisors. I think, again, this is probably the most difficult part of the regulatory agenda. I would say that if I had to say what is the most difficult, I would say resolution and perhaps the shadow banking, because it's a very broad concept. These are very, very difficult. But and I would not say we are yet there, but if you look backwards, a lot has been achieved.
So what I hear you saying is, with regard to this third transition and what you have been, you want to keep this front and center in terms of attention. You're not saying, you're actually saying, look, the agenda is the right agenda, but don't let up. We have a long way to go on some of these things. We've made a lot of progress across the board, but we're not finished. And that is your purpose in talking about this third transition.
Exactly.
In the first part of the third transition. Now, go to the second part, which is not so much the regulations, but I guess the process.
I think the first part was making the system more resilient.
Right.
And there were different elements. And the system is not just the banking. We should be aware of new risks that may come up in the future, and perhaps we can talk about that later.
Yes.
Because this is important. Next crisis perhaps will not start in the banking sector. It may start somewhere else. So we need to fight the next war, not necessarily the last war. But as far as regulation, I think we have completed the design, and we are in the implementation part. Now, I was mentioned resilience, but it also have to increase also the confidence it has on the financial system. And I think increasing the confidence in the financial system is not yet completely achieved. This is in part something that the banks have to do, but in part also is to make sure that we are convinced that the risk management of these banks is a proper risk management and is a sound risk management based on good risk culture, etc., and good practices. Some cases in which the practices were not that good, and that is a very important element. And on this element, we think that regulation can play an important role, but it is also important that supervision plays a very, very active role in supervising many of these elements. And for example, there has been doubts about whether the models of these banks are properly used or are used to reduce the capital and arbitrage really too much, or over-optimize the risk-weighted capital that they are calculating. And I think, again, regulation can help to increase the confidence in these systems, can increase some backstops, can increase, for example, the leverage ratio, which is something that still needs calibration, can introduce some minimums in the way that in the United States it has been done by the Collins Amendment. So it can increase these kind of things, but at the end, it will be necessary that the supervisors get into the details of the models and in the validation of the models. It's not that difficult in the sense that you can compare what different banks are doing for the same kind of risks, and that will provide with additional elements of confidence on the risk management of the financial system. And the system will not be only resilient, it will be also reliable. And perhaps the third element would be we need to be aware of new risks, and that is
before we get to that, on supervision, of course, when you talk about it, it is nobody could object to the notion that we need, vigilant and very skillful supervision. But I'm wondering, are you saying that you feel that the supervisory element of confidence is not getting the attention that it needs? In other words, that there's been a lot of focus on regulations, but that supervising needs to be more emphasized more. Is that what is that? You're pointing to this not because it's obvious, but because of something else.
No, I think we have been paying attention, and there has been a lot of work on how to make the supervision better, more intrusive, more effective. There has been a working group, and there has been good guidance. Now we need to implement this. Okay. What I'm saying is we will need, in the same way that we are checking the implementation of the rules, we need to also check the implementation of this more intrusive supervision, because this is going to be key. We cannot think that just adding complexity or adding simplicity to the regulation, we are going to solve the problem. Regulation can go to a certain point, but the rest will have to be supervision. And I think now that we are talking about the implementation phase, supervision is going to gain importance, because this will be what it will first ensure that what it has been regulated, it is happening, and second, it will ensure also that some additional credibility and additional confidence on the processes in the banks, at the banks.
Okay, so let's now talk about risks and how you think about, how we should think about risks, old risks and new risks, and what, you know, what you're advocating in that area. Okay, and I may pose ask you about one or two risks in addition.
Okay, so I think first of all, when we talk about risks now, we should be talking about systemic risks, which are the important risks, and we should not necessarily talk about one institution failing or something like that. The important point is that this should not trigger a systemic crisis. So it's systemic risk that we need to be talking, and this has been the focus. This is the macroprudential notion. This is we tend to think that this will require a collaboration of the different policies, not just one policy. It should not be a silo of regulation, supervision. It requires a good background of interest rates at the right level, because at the end we will need that there is not that the price of leverage is the right one, etc. But at the end we will need this systemic perspective. So in terms of risks, we need to be. There is crises always take a while. They do not come up like a shock. In fact, some of them are the concept of building imbalances for some time. And we should monitor these building imbalances for some time. And they are associated with leverage. That usually has been a constant in the past. And then they manifest, and the trigger may be different, and the manifestation and evolution may be different. So there is always a new element and an old element. But we should look at these old elements of leverage, maturity transformation, these kind of risks, both in banks and in the shadow bank, if you want, or in the capital markets. No, so one element that we are looking at now is what we call the second phase of global liquidity, and this is something that has changed. We need to continue to monitor how the financial system is transforming, is evolving, and in the past, of course, you get international flows of finance, and for some countries, part of the credit to finance the real economy comes from the outside, comes in international flows, and can come in different currencies. In the past, in what we call the first phase of global liquidity, basically it was banks. The protagonists were global banks, and it was global lending, bank lending, and it was leverage, the main driver of, or the common factor that would drive these flows. That was the first phase of liquidity. In the crisis, basically because banks had to rebuild their balance sheet, this dropped dramatically. This cross-border lending dropped dramatically. And now, after the crisis, probably we could say from 2010, there is a new phase of liquidity in the global financial system. And the new phase of liquidity is more based on capital markets. So the dynamism is moving to capital markets. And the new protagonists are the asset managers that are purchasing what is being issued. And perhaps then some of the new things is that the issuers have been corporates, to a large extent, has been corporates in emerging markets. So we have moved to a new situation in which it is capital markets, it is corporates in emerging markets issuing significant amounts of debt, and asset managers that are purchasing this debt. Now, this is a positive development because to some extent what it is indicating is that is not the finance of the economy, of the global economy, is not so much concentrated on banks. It is diversifying and it is moving to capital markets, which in particular for some of these emerging markets is a positive development. Now, what we need to learn is what are the risk profiles of this new pattern of funding. And we are studying that. And I think this is a very interesting concept because, for example, just to give you a flavor of some of the issues that are there, some of the issuance on the part of emerging markets is done in subsidiaries in other countries and in other currencies. So this is not captured by the normal monitoring in the country because it's not debt of this country, it's debt that is issued somewhere else. So the usual balance of payments analysis will not give you this kind of debt. However, it may be a Chinese company or an Indian company or a Brazilian company that is more indebted and it is not registered. So this is important. Now, how much risk there is, it depends on what is done with these funds that they are getting. It could be very positive. It could be making the maturity longer. It could be some kind of hedging of future income in export companies. It could be, but at the same time, there could be currency risk that are built in. And now we are talking corporations. So we are not talking banks. We are talking that some risk could be in corporations. We need to monitor that. We are not saying there are big risks. We are saying that this is new phenomenon, new development that we need to monitor. And the amounts of debt that have been issued is significant.
Who is doing that monitoring? I mean, it's beyond the scope of central banks. To my mind, it would be either you or the IMF or some combination. But
I think we are all. And I think the central banks of the different banks of the different countries are doing that monitoring, and certainly we are collaborating, and other institutions, the IMF. I think we all know that there is an issue that we need to follow. So the attention has been focused on this kind of new issues, and I think there is some monitoring. Now it's not easy because some of these companies do not have any reporting obligation. So it's not an easy. It's not easy, but it can be, to some extent it can be done at least, and central banks are very well aware of that. Now this is the issuer side, but there is also the buyer side, and on the buyer side there is also new issues that we need to monitor, and an important issue is. We have talked about leverage in the banking sector as one of the critical elements for fragilities, for financial fragilities. But the question now that the dynamism is moving to capital markets is to what extent these asset managers that traditionally are less leveraged can bring to the market leverage-like behavior. So to what extent, even if they are not leveraged, for other reasons, for their practices, etc., for their herd behavior, we can talk about that. They can bring similar kind of leverage-like behavior that can introduce strains and distress in financial markets, similar to what it was caused by leverage in banks. So I think this is a very interesting question, and we need to monitor that. All the use of indexes. All the use of perhaps the risk of redemption in some of these asset managers introduce some procyclicality and can introduce some stress selling at some moment. So there are a number of different elements why this non-leverage institutions could produce similar distress to leverage, and we are monitoring that. The search for yield is another one very good example. And in this kind of markets, liquidity will be key. And perhaps we are counting too much on the liquidity, and we don't know what will be the liquidity in the future. So I think there are a number of elements that we are still starting to explore, and it's just to give you a sense that it is not just regulating banks. We need to make sure that potential risks, and we don't know if this will be the next strains in the financial markets, will be coming from the capital markets, from these elements, but we need to make sure that we are following it, but also others are following it.
So let me ask you one last category, and this would be in the arena of what I would call long-term concerns, not immediate financial risks, but let's say elements that could really impact the global financial system over the next decade or so. So one is I'll call it the integrity of central banks. Integrity not in a moral sense, but we have had a long period where central banks have become more independent, where I think respect for central banks as the ultimate pillar has grown, even despite the the financial crisis. And I just wonder how now that central banks have sort of acquired lots of other mandates and have engaged in policies that are much different than what we have been used to. To what degree do you have any concerns about the character, the independent character and competence of central banks, over the next decade or two? Is this something to be concerned about, or is this really not an issue?
I think it's a very important question, and I think it's certainly true that central banks have now more functions. Financial stability, it will be an additional function, perhaps a more active function than before. Not that some banks didn't have it. Right. Sometimes some central banks had already that, but it has become clear that at some point of time this will be necessary and this will be very active. And we don't have a framework for integrating policy and financial stability. We don't have it yet. This is a conceptual challenge that central banks have to face, how to integrate these things. But you are right. I think in addition to the conceptual challenge, there is an institutional challenge. And the fact is that when you are entering in the area of financial stability, we are entering in a more complicated area, in the sense that financial stability is a shared responsibility. It's not totally responsibility of the central bank. It's also a shared responsibility with government. The lines between fiscal and monetary are blurred to some extent. Some of the activities of the bank could be done by the government or by the debt authority. I mean, for example, reducing maturity of the bonds. It could be done just by purchasing by central banks or by issuing less. So there are equivalents, and this indicates that the lines are blurred, and this could affect also the finances of the central banks, which is important from the perspective of independence. And most importantly, it creates issues in the relationship, in the coordination with governments.
Right.
Now, what is the solution for that? First, we need to recognize that this is the case, and that perhaps the central banks that we thought could live in the past, that you just take care of monetary stability and the rest will happen, is not the case, and that central banks will have to pay more attention to financial stability more than in the past. And I think the key of all that, it will be to establish a better governance. And the better governance of this cooperation, in my view, is clarity in the different responsibilities. At the end, the central banks are independent because they receive this independence is a kind of double delegation from the citizens to elected representatives and from elected representatives to central banks. And I think this is a double responsibility if you want. It requires accountability. It requires that the mandates are clear and that the delegation is not very wide, because otherwise it's too much. But at the same time, it has to be. We have learned that that central banks will need a lot of flexibility if they have to perform their functions. And in my view, if anything, another lesson of the crisis is that the independence is very important. Some of these decisions are very difficult decisions, and it should be taken away of the, I would say, political timing, the political cycle. So it has to be taken independently of the political cycle. And for that, you need to delegate the powers to someone with the mandate to do exactly that, which it was the case for monetary policy. I think it will be the case also, for example, for some of the macroprudential. Again, in financial stability, it's a shared responsibility, but I think it reinforces the notion that this independence will be needed, but it will be more complex, and this relationship will be more complex. So I think if you look at the central banks of the future, I think we will see that we need to develop better frameworks, conceptual frameworks, but we will also need to develop better governance that take into account all the lessons that we have had in this crisis. But I think this can be done, and there has been some work here at the BIS in a group of governance where we are, and there have been a number of papers published where we go in this direction. It is clarity, ex-ante clarity on what you can expect from central banks and what you shouldn't expect from central banks. And that can be done changing mandates, and perhaps not necessarily changing mandates, but interpreting mandates with this in mind.
I like the term ex-ante clarity. That would be great. It's obviously very difficult given that.
Very difficult.
Okay, here's another issue, and I put it again in the category of long-term. It has to do with the integration of China into the global financial system. And I think at least the way I look at this is, when it comes to trade, China is fully integrated. When it comes to finance, it is clearly moving in this direction, but no one would say it is fully integrated so long as there isn't convertibility and the currency isn't widely used. But this is a gigantic new factor in the global financial system. I mean, this isn't something marginal, right? This has enormous implications. So I'm wondering that, if you took a 10-year period, how do you think about this integration in terms of the challenges that need to be met so that it goes smoothly?
Well, first, I think this should be presented as a positive element. I mean, integration is a positive development. It has to be done carefully, and we will discuss about that, but I think it's a positive element for the world economy. It's a large economy, it's a growing economy. It is developing their markets rapidly, and I think this would be positive in terms of risk diversification in many aspects that will contribute. So there will be more opportunities for investors to find new places to invest, and there will be plenty of opportunities for Chinese investors also to invest abroad. Now, the investment of China abroad is quite large, but it is mostly done through, I would say, official channels. Is the investment of the reserves, or is the investment of some official channels? I think the liberalization of the capital account would provide with additional opportunities in both ways that should be welcome. And I think that is the spirit
right,
with which we should look at that. Now, having said that, of course, any big transition has some challenges. And I think the challenge for China would be to make sure that the sequence and the transition is orderly and properly done. I think they are doing that. They are doing in a very slow process. And I think the first element would be to let more the market forces to determine price, interest rates, exchange rate. Let this happen more openly and more clearly. I think this is one of the steps that probably will be needed. And also the strengthening the financial system, making sure that the financial system is able to cope with the different challenges that will come, one that it is fully integrated in the global economy. And I think this is also happening. It is true that we have seen quite significant amount of credit growing, and that it is the shadow banks, and all this needs to be monitored carefully and need to be assessed to what extent this is ready for the full integration. But if, as you say, we are talking in a transition of a number of years, in 10 years, I think this is perfectly feasible. And from my perspective, if these precautions, making sure that market is able to work before fully open all the capital accounts, but it is starting to work more clearly, market pricing, and the resilience of the financial system and the interaction of the financial system with the rest of the world is progressively open, I think it would be a welcome development for China, and it will bring opportunities for the rest of the world. So I would look at that very, very positively.
Okay, and the final question has to do with your feeling about financial globalization. You already identified kind of a new kind of capital flow, or not new, but a change in the proportion of how money is moving across borders. At the same time, we see efforts to ring-fence institutions, and we see efforts to demand much more capital when it comes to foreign subsidiaries of institutions. And as you said, there's a big pullback in lending among a lot of banks. So in all the commentary about whether either financial globalization has slowed or even begun to reverse, how do you think about that? Is there any merit to that kind of thinking? Is it something we should be cautious about, or do you feel that this is really a sideshow to the growing integration that is going to inevitably continue unless there's some unforeseen calamity?
No, I think we should be vigilant on this, because there are always tendencies to, again, you find your own way, protect, or become more nationalistic approaches. This is normal in periods where there are plenty of tensions and plenty of and crises and risks. But I think this would be very negative. This would be moving backwards. We have got significant benefits in the process of financial globalization. We have also learned that we have more risks that we have to be also aware. So we have big now motorways that are very good, but also move very rapidly the risks. So we need to be aware of that. But overall, the process of globalization is a very positive one. And I think we have been able to contain these risks of fragmentation, but I think we should be very monitoring that very carefully, because small things could start to trigger that everyone goes their own way, and that would not be good. That would be moving backwards. But frankly speaking, I'm optimistic. I think that some of these have been prevented, and the fact that one jurisdiction asks for more capital than other jurisdiction, provided that it is done on an equal basis, is not necessarily a bad development. We have been living with that for a long time, and the fact that different jurisdictions have different rules for their own, I would say, a structure of the banks, we have also been living with that in the past. Perhaps it's not optimal, but I would say that this is not necessarily leading to more fragmentation. So the capital markets were, and Basel I was living with Glass-Steagall. So okay, So it's not perfect, and we should be trying to move to more consistent rules. But I think we also need to recognize that there are differences among jurisdictions, and some differences will be natural and will not impede the continuous growth of this better integration. But I think, again, I think we should be vigilant, and we are vigilant, and I think if there are risks of fragmentation, we should really seriously address these risks, because this will not be a positive development. So we should not be relaxed about that.
Well, that's a good place to stop. I want to thank you very much for a very, very stimulating discussion. We covered a lot of ground, and I found it incredibly interesting. So thank you very much.
Thank you. Thank you very much for having me. Thank you very much. It has been a pleasure.